Imagine you've spent, I don't know, years, literally years, mastering the rules of a game.
Right, investing all that time.
Exactly. You know exactly how the pieces move. You know the strategies, the openings, defensive plays.
They've got it all mapped out.
Yeah. You sit down at the board, you're feeling confident, running the exact mathematical models that have consistently delivered returns for you.
The ones that always work.
Right. Then, overnight, the rules change. But nobody tells you.
Oh, man. That is the worst feeling.
It really is. Like suddenly the knight doesn't move in an L shape anymore.
Yeah.
The bishops are moving like rooks.
Total chaos.
Yeah, and you keep playing the way you always have, applying the exact same logic that made you a winner yesterday, and you just keep losing.
You're just bleeding chips.
Every single move, you get crushed. So what do? Do you blame the board? Do you blame your opponent?
Most people do, yeah.
Right. Or do you realize that the game you are playing is fundamentally not the game you thought you were playing?
That's the real realization right there.
Because you keep losing. And it's not because you forgot how to trade or manage a portfolio. It's because geopolitical stress doesn't just move prices.
Yeah.
It rewrites the physics of the market entirely.
Completely rewrites them.
And that is the absolute reality of trading through a crisis.
It is. It is a
Yes.
terrifying moment of realization. And, it happens faster than human psychology can even process it.
Oh, absolutely.
Most participants, they look at the news, they see a geopolitical crisis, a conflict, massive supply chain fragmentation, maybe a trade war.
Something scary on the terminal.
Right. And they fall back on this really simple input-output mechanism. They think, well, bad news means prices drop, so we'll just short resistance.
Because it's just a normal Tuesday.
Exactly. But they don't realize the gravity has shifted. Like the actual friction of the market has fundamentally changed.
Which means the structural filters, the very lenses that you use to read the tape and make decisions, are fundamentally distorted.
They're warped.
Yeah, totally warped. So whether you are actively managing a large fund or whether you are day trading order flow or you're just trying to understand why your diversification models completely failed you this morning.
Which happens to a lot of people.
So many people.
Yeah.
Well, this deep dive is going to hand you the decoder ring. We are exploring the hidden mechanics of how geopolitical stress warps market reality.
It's so important to understand this.
It really is. We are unpacking why the old rules fail, the exact mechanisms that physically break your charts, and how the new rules are written in real time by algorithms and human panic.
Yeah, because it requires a complete paradigm shift. I mean, if you treat a stressed market like a normal market that is simply, moving faster,
You're going to get wiped out.
you will absolutely lose your capital. The molecular structure of how buying and selling occur has just been altered.
Now, here's where it gets interesting. Before we can really understand how geopolitical stress breaks the market, we have to establish the baseline of the illusion.
The baseline, right.
Yeah, we have to look at what normal actually looks like before it shatters. I mean, we all rely on market structures.
Oh, sure. Trends, ranges, support.
Resistance, liquidity sweeps, all of that.
Yeah.
But there's a quiet underlying assumption that almost all market participants make.
And what's that?
If price behaves a certain way often enough, it can be trusted to do it again.
Yes. We absolutely rely on pattern recognition to allocate capital. But the vital distinction here, and this is key, is the difference between market structure and structural filters.
Okay, break that down for us.
Well, the structure is just the geometry of previous transactions. It's just what happened. But the filter is the rule you use to trust it.
Give me an example of that.
So a breakout is the structure. The filter is the rule that demands price must close beyond a specific deviation, right? And show follow-through volume to be considered a valid signal.
So it's the confirmation.
Exactly. The filter is your condition for trust in an environment that is just full of noise.
And in a normal market, we implicitly trust these filters because the environment supports them. Like liquidity is balanced.
Right. Buyers and sellers are matching up.
Exactly. We have roughly equal amounts of buyers and sellers interacting. Volatility is, contained within expected statistical bands.
It's predictable.
Yeah. But more importantly, participants are acting on logical economic incentives.
Yes, the rational actor theory.
Right. They are analyzing interest rate differentials, corporate earnings growth, capital flows, and when millions of participants and algorithms are all behaving rationally to optimize yield,
You get a clean tape.
you get a highly coherent market structure.
And that coherence is what makes pullbacks tradable. I mean, it is what makes support levels actually function.
Because everyone agrees they should.
Right. Buyers step in exactly where quantitative models suggest they should step in, all based on valuation metrics. The market follows this logical script driven by the pursuit of capital efficiency.
It's like driving on a dry highway.
That's a great way to put it.
Yeah, you trust your brakes, you trust the lane markers, and you trust that the other drivers are generally trying to get to their destination safely.
Nobody is actively trying to crash.
Exactly.
Yeah.
But wait, is the market ever truly normal? Or is this baseline of efficiency just a temporary illusion, like a consensus reality that we've all collectively agreed to believe in until we are forced not to?
Honestly, normal is entirely a consensus reality.
Wow, really?
Yeah. What we call normal is merely a state where participants have the luxury of pricing growth.
The luxury. I like that word.
It is a luxury. We collectively agree the system is stable enough that we can focus on optimizing profit rather than, optimizing survival.
Right. We're not dodging bullets, we're planting seeds.
Precisely. That baseline allows for statistical models to work, but that baseline is incredibly fragile.
Which brings us to the catalyst that shatters that consensus.
Mm.
Because we've established that normal structure relies on economic incentives, right?
Right.
So what happens when survival replaces economics? This is the anatomy of a geopolitical regime shift.
It gets ugly fast.
It really does. We are talking about systemic shocks. Military conflicts, sudden trade embargoes, energy supply disruptions that threaten the electrical grids of entire nations.
And here's the crucial distinction. The market reaction is rarely about the physical event itself.
Wait, really? It's not about the event?
No, it is entirely about what the event does to forward expectations.
Okay, that makes sense.
Because the market is a forward-looking discounting mechanism. When severe geopolitical stress hits, that great transition occurs.
Great transition.
Yeah. The market instantly stops pricing yield and optimizes entirely for safety. It just abandons the pursuit of efficiency and is forced to price in massive, unquantifiable uncertainty.
Okay, let's unpack this, because this is where a lot of quantitative models get tripped up, right?
Oh, constantly.
Mechanically, if capital is just seeking a hiding spot, say an institution gets spooked and moves $10 billion out of emerging market equities and into short-term U.S. treasuries.
A classic flight to safety.
Right. Doesn't that just mean money is moving from point A to point B? Like it's just a reallocation. Why does the simple act of reallocating capital completely break the structural charts?
Well, if we connect this to the bigger picture, it is not the destination of the money that breaks the market.
Okay, what is it then?
It is the speed and the desperation of the exit.
Yeah, desperation.
Yeah, think about it. In a normal environment, an institution rotating out of equities into bonds does it over weeks.
They don't just dump it all at once.
Exactly. They use execution algorithms like VWAP, volume-weighted average price, to gently feed their orders into the market so they don't disrupt the tape.
Right, they want to hide their footprints.
They are waiting for liquidity to absorb their selling. They are highly, highly sensitive to price.
They want the absolute best execution.
Exactly. But under extreme geopolitical stress, price sensitivity just vanishes. The psychology fundamentally shifts.
Because they're scared.
Because they are terrified. Capital no longer cares about the optimal return. It seeks absolute protection.
Just get me out.
The entire market shifts into a defensive crouch simultaneously. Portfolio managers aren't waiting for a good price. They are literally picking up the phone and screaming, "Get me out at any price."
Wow. But the real story is how this macro shift to survival physically alters the mechanics of buying and selling on a micro level.
The plumbing of the market.
Yes. How does fear physically dismantle the order book? Let's look at the four horsemen of structural distortion, starting with the first mechanism. Liquidity becomes asymmetric.
This is a huge one because under normal conditions, market makers provide continuous bids and asks. They are the shock absorbers of the market.
The people standing there willing to buy or sell at any moment.
Right. But market makers run on value at risk, or VAR models.
VAR models, right?
Yeah, these algorithms calculate the maximum potential loss over a specific time frame. And when a geopolitical shock hits and standard deviations blow out, those VAR models trigger automatic risk limits.
They just shut off.
The algorithms are literally mechanically forced to pull their bids from the market to protect the firm's capital.
So the shock absorbers are removed exactly when you hit the biggest pothole.
Precisely. The order book just evaporates. You have Thousands of participants aggressively rushing for the exact same exit door, and the entities that usually buy from them have completely disappeared.
They've gone home.
They are gone. The result is asymmetric liquidity. Price doesn't interact with structural levels anymore, it teleports through them.
Teleports, that's a great word for it.
It really does. A major support level fails instantly, not because there was overwhelming selling pressure, but because there was a total vacuum of buying liquidity.
And that leads directly into the second horseman. Volatility expands far beyond normal bounds. And we aren't just talking about prices moving down faster here.
No, not at all.
We are talking about the complete failure of standard deviation models.
Think back to the unpegging of the Swiss franc in 2015.
Oh, man. That was wild.
It was historical. For years, the market had a totally artificial, constrained volatility environment managed by the Swiss National Bank.
Right. They held it in a tight box.
And when that peg was unexpectedly removed, the standard deviation models didn't just bend, they completely shattered. Volatility didn't increase by 10%. The currency moved 30% in minutes.
30% for a major currency. That's insane.
It's unheard of.
Which fundamentally alters how you manage risk. I mean, if you are a trader who normally hides your stop loss just outside the average true range of an asset, thinking you are mathematically safe from daily noise,
You're not safe at all.
you're suddenly incredibly exposed.
Your safety net becomes a target. Because when geopolitical stress expands the ranges violently, those stops that were logically placed based on historical data are suddenly swept up in the new, vastly wider intraday range.
They just get tagged easily.
Exactly. Price completely stops respecting statistical boundaries because the boundaries were built on peacetime data.
Peacetime data doesn't work in wartime.
Nope.
Which brings us to the third mechanism, and honestly, this one is the most disorienting to me. Time compresses.
Time compression is fascinating.
Because we are used to structural moves taking time to develop. Like a massive bottoming process might take 3 months of complex consolidation, right? Allowing millions of shares to change hands and build a solid foundation.
A nice healthy base.
Exactly. But in a crisis, that fast forward button just gets jammed.
Look at the 2020 COVID crash. I mean, we saw a decade's worth of economic repricing happen in roughly 3 weeks.
3 weeks.
Consolidations shrink to nothing. Breakouts happen with zero structural buildup. And the reason this destroys structural filters is because time equals participation.
Okay, explain the mechanics of that. Why does a lack of time invalidate a move?
Well, when an asset builds a base over 3 months, buyers are slowly accumulating and sellers are exhausting their inventory, right?
Yeah, it's an exchange.
That physical exchange of capital builds a structural floor. But when time compresses and a market drops 30% in 3 days, there is no broad participation.
It's just falling.
It is a sheer liquidity vacuum driven by algorithmic selling and margin calls. There is no foundation beneath the move, which means the ensuing rallies are equally violent and completely unanchored to historical structure.
So the foundation hasn't cured, so any structure built on top of it is structurally compromised from day one.
Exactly. It's built on sand.
And that perfectly sets up the fourth and final horseman narrative, completely overrides technicals.
This is where pure technicians really struggle. In a peacetime market, a technical analyst can completely ignore the newsfeed.
They just look at the price action.
The tape tells the story. But during severe geopolitical stress, think about the immediate aftermath of the invasion of Ukraine in 2022.
Right. Everything went crazy.
Price completely stops reacting to supply and demand levels and purely reacts to information flow.
Because you have natural language processing algorithms, right?
Yep.
They're reading news headlines, parsing the sentiment, and executing multi-million-dollar trades in milliseconds.
Milliseconds. A headline about a pipeline explosion or a central bank emergency meeting hits the terminal, and the algorithms instantly reprice the asset class across the board.
Before a human can even blink.
They completely ignore whether the asset was sitting at a major technical support level. Structure becomes entirely reactive, not predictive.
That's a huge shift.
The chart is no longer a map of future probabilities. It is merely a chaotic footprint of the last 5 headlines.
But if I'm listening to this, I'm thinking, if price is teleporting through levels because VAR models pulled all the liquidity and standard deviations are blowing out and time is compressing so there's no foundation and algorithms are just trading headlines.
It sounds hopeless.
Yeah. Aren't technicals just completely useless? Like, why even look at a chart? Why not just trade the news feed?
And that is the ultimate track. Traders throw their hands up and say the charts are broken, but the structure isn't gone.
It's not.
No. The basic laws of supply, demand, and human fear still exist. The problem is that traders are using the wrong lens. They are looking for a magnifying glass when they need a telescope.
I like that.
They are trying to apply normal market filters to a stressed market environment. The tape is still leaving clues, but the language has fundamentally changed.
Okay, so let's talk about the mistranslations of that language. Because the underlying mechanisms are broken, the specific technical signals that participants rely on begin to misfire in highly dangerous ways.
Extremely dangerous.
Let's look at the breakdown. The most immediate failure is the multiplication of false breakouts.
Yeah, false breakouts are brutal. In a healthy market, a breakout signifies a genuine shift in auction theory. Buyers overwhelm sellers at a key level, and price discovers a new value area.
It breaks out and stays there.
But during geopolitical stress, breakouts are often just algorithmic reactions to a headline spike.
Right, an algorithm reads a headline, instantly buys market order, and price spikes violently through a major resistance level.
It looks amazing on the chart.
Yeah, on a 5-minute chart, it looks like the most powerful, undeniable breakout of the year.
But there is no real institutional positioning behind it. It's an illusion created by a lack of liquidity. So price moves aggressively beyond the level, drawing in retail and systematic trend followers who use the traditional filter of buy the breakout.
They take the bait.
And then, the moment the initial algorithmic reaction fades, there are no actual buyers stepping up to support the new price. The market violently reverses, trapping everyone who bought the high.
Ouch.
The classic break-and-hold filter completely loses its reliability.
And what happens to traditional support and resistance? Like, say you have a massive structural floor where an index has bounced 3 times over the last year. You assume there are huge institutional buy orders sitting right there.
Right, normally you would. But under stress, the market reprices too quickly for static levels to matter. The institutions that had buy orders sitting there, they have already pulled them because the macro narrative changed.
They canceled the orders.
Exactly. So instead of price coming down to that level, pausing and giving you a clean entry, gravity takes over. It's like trying to catch a falling safe because you think it's a bouncing ball.
That's a terrifying image.
The market slices straight through the floor without even pausing to acknowledge it exists.
Wow. Let's talk about liquidity sweeps, because this is where a lot of sophisticated order flow traders get absolutely destroyed.
Oh, the stop hunts.
Yeah. In peacetime, you see price dip below a major low, trigger a bunch of retail stop losses, and then violently reverse higher. It's a deliberate action by larger players to generate liquidity so they can fill their own massive buy orders.
It's an intentional head fake. And in normal times, buying that sweep is an incredible edge.
It's a great setup.
It really is. But in wartime or severe systemic stress, it becomes mathematically impossible to distinguish between a deliberate stop hunt and the beginning of a massive liquidation cascade.
Unpack that liquidation cascade for us. What is mechanically happening behind the scenes there?
Well, a liquidation cascade is driven by leverage. When volatility explodes, funds that are heavily leveraged suddenly face margin calls from their prime brokers.
The broker wants more collateral.
Right. The broker demands more cash to cover the expanding risk. If the fund doesn't have cash, the broker forcibly liquidates their positions at market price.
They just sell it all.
This indiscriminate selling pushes the price even lower, which triggers the next fund's margin call, which triggers more automated selling.
The domino effect.
Exactly. So when price violently pierces that major low on your chart, it looks exactly like a stop hunt. But it's not a head fake to reverse the market. It's the first wave of forced liquidations.
So if you apply your peacetime filter and buy that sweep expecting a quick bounce, you are stepping in front of a mechanical feedback loop of forced selling.
You're standing on the tracks in front of a freight train.
The market isn't sweeping liquidity to reverse, it is consuming liquidity on its way to discovering a completely new, much lower value area. Trusting that signal blindly is fatal.
It will end your career.
So what does this all mean? If I'm looking at my screens, it's like relying on a highly detailed street map of a city, while a massive earthquake is actively rearranging the topography.
That's exactly what it is.
You are standing there saying, the map says there's a bridge right here. But the bridge is gone. There's a chasm there now. The map isn't fundamentally wrong. The ground itself is just moving.
This raises an important question. How do we navigate moving ground? If the traditional filters are leading us off a cliff, what is the solution?
Let's zoom out for a second, because we need to shift from these granular mechanical breakdowns to the high-level solutions.
Yes. Let's look at the fix.
If the old filters lead to consistent capital destruction during geopolitical stress, The answer isn't to just close your brokerage account and quit.
No, of course not.
The answer is to adapt and upgrade the filters. We need to recalibrate.
And the absolute first step in recalibration is forcing yourself to widen your validation criteria.
What does that look like in practice?
If weak confirmations, like a quick 15-minute spike through a level, are now just algorithmic noise, you have to demand stronger mathematical proof from the market before you commit capital.
It means ignoring the lower time frames entirely, doesn't it?
Entirely. You need to wait for multiple closes beyond a critical level on a daily or weekly chart. You have to demand alignment.
Alignment.
Yeah. If the 4-hour chart looks incredibly bullish, but the weekly chart is in a relentless downtrend, the peacetime filter might say, take the short-term trade. The wartime filter says, absolutely not.
You're essentially forcing the market to prove that the capital flow is real and not just a momentary panic reaction to a tweet.
Exactly. The first move is emotion. The second or third move is reality. In a stressed regime, patience transforms from a psychological virtue into a literal mathematical edge.
That makes a lot of sense.
Yeah.
And the next step is completely inverting your analytical process. Macro context must dictate the bias.
Always.
In stable conditions, structure can lead your analysis. You can trade a pristine technical setup without ever looking at the macroeconomic calendar.
You can just trade the chart.
But in stress conditions, doing that is financial suicide.
You must start by mapping the capital flows. Who benefits from this geopolitical shift?
Right. Where is the money running to?
If energy infrastructure is under threat in Europe, and capital is desperately fleeing into the US dollar for safety, that is your primary truth. Only after you understand that macro reality do you look at the chart.
Structure becomes confirmation of the macro thesis, not the signal itself.
Yes.
If the chart setup aligns with the massive flow of capital into the dollar, you take the trade. If the chart shows a beautiful setup to short the dollar, you ignore the chart because the macro gravity is entirely against you.
You don't fight the gravity, and that leads to the most practical and usually the most painful recalibration adjusting risk parameters.
Nobody likes doing this.
Nobody. Because standard deviations have doubled or tripled, the structural adaptation in your execution must reflect that mathematical reality. Position sizes must decrease heavily.
And this is where people get confused. They think, well, if I shrink my position size, I'm not going to make any money during these massive moves.
Is it a common fear?
But they forget that you are pairing a smaller position size with a massively widened stop loss.
Exactly. Let's look at the math, right? If you normally risk $10,000 on a trade, you might buy 1,000 shares with a $10 stop loss.
Simple math.
But in a geopolitical crisis, the daily noise alone will trigger that $10 stop. The volatility requires a $30 stop just to stay in the trade.
Just to survive the wiggle room.
Right. So to keep your total risk locked at $10,000, you must cut your position size down to 333 shares. You are giving the trade 3 times as much room to breathe, but risking the exact same dollar amount.
You are widening the net to account for the wider swings. And hand in hand with that is a massive drop in trade frequency.
This is where human psychology absolutely self-destructs.
It really does.
When the market is moving with extreme velocity, when commodities are swinging 5% a day, human nature looks at that volatility and equates it with opportunity.
The brain screams, I should be trading 3 times as much.
Exactly.
I mean, if I'm sitting at my desk watching crude oil rip $8 in a session, telling me to sit on my hands and wait, feels like you're asking me to fail.
The urge to do something is overwhelming.
The FOMO is deafening. How is doing nothing a viable strategy when generational wealth is seemingly changing hands every afternoon?
It is viable because the alternative is getting chopped to pieces by the false signals we just discussed.
Right. Death by 1,000 cuts.
Increasing trade frequency in a highly unpredictable, low liquidity environment is the fastest way to trigger a massive drawdown. The professionals survive these regimes not by catching every swing, but by filtering out the 90% of moves that are just algorithmic noise.
And striking only when it's perfect.
Striking only when the macro narrative and the higher time frame structure perfectly align.
And part of that filtering involves filtering by sensitivity, recognizing that certain hours of the day are radioactive.
Yes.
If there is an emergency central bank press conference or a known window where military escalation is highly probable, you do not hold short-term risk. You step aside.
Avoiding exposure during periods of peak sensitivity is a critical skill. Sometimes the most profitable action you can take in a day is actively deciding to protect your capital.
Just keeping what you have.
Exactly.
Now let's apply all of this across the board. Because geopolitical stress is a global shockwave, but it doesn't warp every market in the exact same way.
No, it hits different sectors differently.
If capital is blindly fleeing into the US dollar for safety, that massive vacuum of liquidity doesn't just stay isolated in currency markets. It immediately bleeds into everything else. Let's look at the ripple effect across asset classes, starting with foreign exchange.
FX markets undergo a total identity shift. In peacetime, currencies trade based on subtle differences in interest rate yields between central banks.
Right, it's a game of basis points.
But in a crisis, currencies stop trading on yield and become pure, unadulterated proxies for safety and geopolitical exposure.
Safe haven flows completely dominate. The
Yeah.
US dollar, the Swiss franc. These currencies see massive, relentless inflows simply because they are viewed as the deepest, safest harbors in the global financial system.
And that directional bias crushes technicals. If you are trying to short the US dollar based on an overbought indicator or a technical resistance level during a global panic, you are going to get run over.
Steamrolled.
Macro alignment completely overrides technical precision. You also see incredible dislocations in resource-linked currencies. The Canadian dollar or the Norwegian krone might suddenly decouple from their normal correlations and trade purely as derivatives of crude oil prices.
Speaking of crude oil, let's move to commodities. Because during a geopolitical crisis, commodities are the absolute center of gravity.
Oh, without a doubt.
They are the most direct, visceral expression of geopolitical fear.
Energy and precious metals become the main characters. Oil reacts violently to supply disruption risks.
It's so sensitive to supply threats.
If there is a credible threat to the Strait of Hormuz or a major producing nation's infrastructure, oil isn't going to smoothly trend upward, giving you nice pullbacks to buy.
It doesn't give you a chance to get in gracefully.
No, it is going to gap up 10% overnight. It is going to experience sharp, violent spikes that trap anyone caught on the wrong side.
Gold operates similarly, but it reacts to a different kind of fear. It reacts to systemic uncertainty and the fear of fiat currency debasement.
Which means the charts for commodities during these times are characterized by extended dislocations. The price entirely disconnects from historical averages.
It just lives in a new reality.
You have to understand that technical structure in commodities during a war is entirely secondary to event-driven repricing. You are not trading a cup-and-handle pattern. You are trading the probability of a sanction taking 2 million barrels of oil off the global market.
And finally, let's look at equities. The stock market is where the vast majority of participants have their wealth tied up. What happens to the internal structure of the S&P 500?
The most profound and destructive shift in equities is the transition from valuation-driven pricing to risk-driven pricing.
Nobody cares about the fundamentals anymore.
Nobody cares about a company's price-to-earnings ratio. Nobody cares about their forward guidance, their dividend yield, or their incredible balance sheet. The market completely stops differentiating between a fundamentally robust company and a fundamentally toxic one.
Which causes a massive, dangerous spike in sector correlations. We see correlations move towards 1.0. Explain exactly how that happens mechanically. Why does everything move together?
It happens because of how modern markets are structured around passive index funds, ETFs, and quantitative risk parity models.
Passive money.
Right. When a massive geopolitical shock hits and a risk parity fund needs to de-risk its portfolio, it doesn't sit down and analyze which specific tech stocks are good or bad. It hits a button that systematically sells a basket of the entire S&P 500.
They are selling the index, not the individual companies.
Precisely. And when massive institutions are indiscriminately liquidating ETFs to raise cash, the arbitrage algorithms that keep ETF prices in line with their underlying stocks are forced to sell the underlying stocks indiscriminately.
Wow.
It creates a mechanical feedback loop where every single stock in the index goes down at the exact same time, regardless of its individual merit.
It's like a flock of birds spooked by a predator.
It's a perfect analogy.
They aren't flying to a specific destination anymore. They aren't looking for food. They are just moving together as a single mindless mass away from the threat.
Relative strength completely breaks down. And the terrifying part for traditional investors is that traditional diversification, holding some technology, some healthcare, some utilities, offers absolutely zero protection.
Because it all drops at once.
Because the liquidity vacuum drags everything down simultaneously in a dash for cash.
So we've covered the mechanical breakdowns, the psychological recalibrations, and the asset class ripple effects. Now, Let's bring it all together into a strategic framework.
Let's do it.
If we know exactly how these assets behave, how does a participant actually execute a strategy without getting destroyed? Let's talk about the strategic implications of a campaign-based approach.
A campaign-based approach means you are entirely abandoning the idea of scalping small moves on short time frames.
No more day trading the noise.
Right. You are building a position over time based on a larger macroeconomic thesis. In a stressed regime, these campaigns must become purely narrative-driven.
Direction matters infinitely more than precision. If the overarching macro narrative dictates that global supply chains are fragmenting, causing structural inflation, your focus is entirely on getting exposure to that trend.
Exactly.
You don't stress over buying the absolute perfect bottom tick of a 15-minute chart pullback.
Because the microstructure is entirely noise. The lower time frames are just a battleground of high-frequency algorithms executing on headlines.
The wood chipper.
The false signals will bleed you dry. You must anchor yourself to the higher time frame, the daily and weekly charts. That is where the genuine institutional capital flow leaves a footprint that cannot be faked by a single news spike.
Which brings us to the concept of contextual errors. Because most of the massive losses traders take during these crises aren't actually technical errors.
That is the tragedy of it.
Yeah.
A trader will execute a textbook setup, a flawless technical pattern on the chart. They manage their risk perfectly. But because they ignored the geopolitical context, because they ignored the fact that a major escalation was announced 20 minutes prior, or that capital was aggressively fleeing the currency they were trading, the trade fails spectacularly.
The operation was a success, but the patient died.
Exactly.
They applied peacetime logic to a wartime environment.
It is the ultimate contextual error. You cannot divorce the structure from the environment in which it prints. The traders who survive these regimes are the ones who redefine how they interpret structure, who control their psychological impulses, and who preserve their capital for the very rare moments of genuine macro-aligned clarity.
Survival first, profit second.
Huh?
So let's bring this all the way home. We started this deep dive with the analogy of a chess game where the rules suddenly change.
Yep.
Over the last hour, we've unpacked the underlying physics of that change. The core thesis here is that market structure never actually disappears. Support, resistance, liquidity. These concepts are permanent fixtures of option theory.
They are the physical realities of human transaction. They always exist.
But the environment operating around that structure changes violently. The distribution of liquidity evaporates.
Yeah.
The baseline of volatility expands exponentially. The macro narrative completely paralyzes the technical.
It's a new world.
And because the environment mutates, the structural filters we use to interpret the market must mutate with it. A breakout isn't just a breakout anymore. A support level isn't a concrete floor. It's a suggestion. Structure is truly only as useful as the macro context you use to understand it.
And if you stubbornly refuse to upgrade your filters, you are attempting to trade a historical reality that has literally ceased to exist.
But I want to close by looking forward because the game isn't standing still. The speed of the market is only accelerating. We now have algorithmic systems and artificial intelligence networks reading complex geopolitical developments, translating foreign news alerts, and executing massive orders before a human being can even process the first word of the headline.
We have fully entered a machine-driven pricing environment.
So think about this. If market structure is ultimately just a reflection of collective human psychology, our fear, our greed, our panic, what happens to these structural filters when AI begins pricing in geopolitical stress faster than humans can even feel the fear?
That is the million-dollar question.
Do the filters compress even further? Does a reaction that used to take 3 days now take 3 milliseconds? Or do the structural filters we've relied on for the last century eventually break entirely, requiring a completely new kind of machine-readable map?
That is the absolute frontier of market mechanics, and we are arriving there much, much faster than anyone anticipates.
It's something to think about the next time you see a breaking news banner flash across your terminal. The next time the geopolitical cycle heats up, before you draw a single line on your charts, take a hard look at your own filters. Because in the markets, especially when the world turns upside down, absolute adaptability is the ultimate safe haven.